I am Nishant. I am the Chief Business Officer of Credit Saison India. Credit Saison India is a Japanese-led NBFC with a 100% subsidiary in the Indian arm, and we are into lending. We are a triple rated entity with exposure to wholesale, retail, and co-lending. Yeah. So I have two eminent speakers today to talk about the digital lending vision of 2030. On my left is Rohan. Rohan is the MD and CEO of TruCap Finance, TruCap Capital Limited. And on my right is Ashish. Ashish is the ex-MD of SVC and is currently a startup evangelist. Some interesting topics that we want to discuss today. And I think to start off, the first would be um, to Rohan probably. And Rohan, uh, your view on path to lowering interest rates for uh, SMEs, NTCs, the inclusion segment that currently are being priced very, very high.
Thank you for that, Nishant. I think, before we talk about how we lower rates towards a particular segment, the most important part to also understand the numbers in terms of not what a number is, but why a number is what it is, right? So, based on whatever has been written, almost 8% of the MSME sector, at least the sector that we focus on, has accessed institutional and non-institutional credit. The rest, 92%, are unaddressed, largely because of two reasons in our view. One is lack of documentation and lack of collateral. Then they can give most traditional lenders. Now, most traditional lenders, the cost of operations are higher. The reason being they go into checking all the collateral, checking all the documentation, etc., which most of these small business owners and even new to credit customers do not have. They do not have the time or bandwidth to access these documents, even if they do have these documents, and they can't spend time away from their businesses or from their day-to-day lives. So essentially, cost of operations of traditional lenders are higher, but the cost of operations are higher, due to which the lending rate is higher, and all they're trying to do is mitigate cost of risk. So at least in our view, cost of risk to come down is the biggest factor in terms of how you can bring down cost of capital to your end borrower. Now, how do you bring that down? I can't speak of the others, but at least for us, what we try and do is most of our customers are very early day-to-day shopkeepers, chemists, kirana stores, cloth traders, shoe retailers, hardware stores, manufacturers of dupattas. Now, they don't have time to deviate from their day-to-day schedules, to step away from their business, etc. So we have to help them tie up with expense management solutions, inventory management solutions, other platforms where we can monitor their credit a lot easier. What that will do for us is help us, or at least potentially help us, mitigate our cost of risk and bring that down. Once we can bring that down, there are several other rebate programs, etc., that you can offer to the same borrower in bringing down the cost of capital. I think the same thing will happen for new to credit customers. New to credit customers, while the intent may be very high, most lenders will take a view saying that they did not know what the willingness of the customer is to repay. So say for instance, for example, I moved back from the US to India about 6 years ago. It was extremely hard for me to get a credit card for 2 years. Even though I lived in my own home, I had a bank balance, for instance, whatever modest amount there was, I belonged, I went to X school, etc. But most traditional lending models will not take that into account. I think the second and most one of the more innovative things that the RBI has allowed, the government's also really pushing on in terms of how you bring down the cost for small, medium enterprises, new to credit customers, is the co-lending model. So, for example, just like you have SaaS companies, which is software as a service, what we call it is lending as a service. So, many small NBFCs, mid-size NBFCs, or even large NBFCs, the biggest constraint that we have is capital. So capital is raw material in my business, human capital and physical actual capital. Now, how do I mitigate that? Because you'll always be hostage to the market in many ways, global events, etc., due to which your cost of capital can go up from time to time, and you have to, again, de-risk from that. So we call it lending as a service. We've tied up with a few large lenders where we will never be able to match their cost of capital or their availability of capital. So we tie up with them in an 80-20 or a 90-10 relationship where the 80% of the book is built for the larger lender, 20% for us, but we are the front face. So we do the sourcing, servicing and collection for the 100% of the money that is lent out to a borrower. And because we can access this money at a cheaper cost, because the cost of capital for these much larger lenders is lower, we can lend to the borrower at a cheaper cost. So eventually it has to be a win-win for the larger lender because they get access to our distribution network. They can reach this last mile customer, which may be very hard for their bank branch managers to reach given the several different KRAs they have to meet, and they can be focused on a particular product through a particular NBFC. So think of us like conduits in that particular segment. It's a win-win for us because we do the hard yards in terms of sourcing, servicing, collection, and we make a slightly higher IRR because there's a service fee that gets paid to us as well, and it's a win-win for the customer. So I think that is, at least in our view, the way for the future in terms of how we bring down cost of lending to the small, medium enterprise borrower, new to credit customer. What's most important is when you tie up in such kind of a partnership, both the lenders have to be very, very sure about the product that they want to cater towards and the segment that they will be targeting, because you don't want to get into a segment that you don't have expertise in.
Understood, understood. I think very interesting. Rohan, one more question there. While the smaller lenders or the NBFCs would probably look at a co-lending kind of a model, how do you think the bigger banks look at it from their perspective? I would want to know that.
So the biggest issue over there, be it for an NBFC or for a large lender, a bank or a large NBFC, is the integration. So, it's much easier to tie up and there'll be several people who will, say that, listen, we can help you guys tie up in a particular product, etc. I think the biggest challenge is in the day-to-day operations. So it's not just about dispersing money to a customer, which is the easiest part. So the customer journey, while that's important, what's most important is whether it fits into the credit profile of the bank, for instance. So does the bank credit policy match with your credit policy? Do you have to make tweaks to the credit policy? That is still the easier part. Once you make tweaks to the credit policy, how does that percolate branch by branch, city by city, state by state to the customer that you're serving? The integration there at the branch level, systems, reconciliation, collection, escrow account openings, etc. It is not a one-step process. It's a multi-layered, complicated process that teams have to be at day in and day out. Now, most banks may not have a plug-and-play tech architecture as well. Most NBFCs also don't have, because this is a fairly new product. I think there are many other players that are trying to develop a platform where lenders can go in and do a plug-and-play for this co-lending module. Still, our personal view is much easier said than done. We've been doing this since August 2021. And I think the one thing I will definitely say is there are so many different nuances, not just in credit policy, but in collection methodology. When can you send a loan recall notice to a borrower? How do you litigate against the borrower, etc. That it's very hard to have a cookie cutter plug and play model that caters towards co-lending. So the biggest challenge here, and I think that will stay for some time, is the integration. Not just tech, but even people integration. Like, people have to be aligned. For instance, for us, the biggest challenge was our branch staff started saying that while you're doing things digitally and integrations happening, are we working for a bank or are we working for the NBFC? हम सर दूसरों का book क्यों बना रहे हैं? Those are the kind of challenges that will come, and that is the biggest impediment towards making this bigger.
Understood. Understood. Thank you. I think very interesting points there. Ashish, your thoughts in terms of lowering rates, whether for SMEs or the intuition segment?
Yeah, thanks, Nishant. I think very well put by Rohan. So if you were to just look at what transpires or means the rate of interest for the borrower. So first piece is obviously the cost of funds or the cost of capital, etc., which obviously larger entities who have deposit taking, etc., tend to have lower cost of funds. So that's one piece, and where this entire co-lending model which Rohan spoke about comes in very, very handy. The second piece which determines is your cost of operations of running the book, and the third piece is the cost of acquisition. And both these pieces, I think, tech has a great role to play there. Some of the pieces which we've seen in the last 4 or 5 years is largely that when the fintechs came in, they did process disruption. So these processes were going on at a similar pace for donkeys a year. Then they came in, questioned that, removed the inefficiencies there. So we are at a stage where decent amount of efficiency gains have happened from a process perspective. Now the third piece is your cost of risk, which needs to be baked in, and the last piece is obviously whatever margins you want to make as a entity. Now what I see going forward, some of the trends which will help us in lowering the cost of end to the end borrower by 2030 or so is if you were to scan the environment and look at it, with the deployment of tech, there's one piece that the large will continue to become larger. But as we say this, there's nuance in what Rohan mentioned, that when you tend to solve for a large piece, the consumer behavior is so different that you will always have a long tail. Then one can keep defining how the long tail is, but there will always be a long tail. So this, while somebody has to keep solving for the long tail, and when the solution reaches a maturity, then it will fall into a bucket where you can bring in efficiencies, etc. And then again, you start solving for the balance tail. So that will be one iterative approach one will need to take, and that will happen. The second piece which I see is in terms of the clear-cut cost of underwriting or cost of risk, etc. Today, by and large, while we've been saying that alternate database lending models, everybody is using it, but my sense is we've still not come of age as far as those are concerned. And in the next 3 to 4 years, or maybe 5 to 7 years, I foresee that developing in. Because of things like Open, ONDC will come in, there'll be a lot more data available seamlessly possible. And then my sense is once Open stabilizes as far as the data from the regulated entities is concerned, whether it is insurance regulator, the banking regulator, etc. At some stage, the telecom regulator will come in and that data will come in. But there will probably be a platform which will be developed where every entity who has a sizable data can put that data on a data aggregated platform for other people to use it with consumer consent, because at the end of the day, the data belongs to the consumer. And there will be monetization available for the person who's collecting the data, as well as the person who's using the data. Pretty much like what Google does with their AdWords, etc., and the Affinity model which they run, but nobody has really used it for a data aggregation platform. So my sense is over the next 5-7 years, I'll probably see that happening. Whether it just comes into play or it stabilizes, only time will tell. But those are good pieces which will help lower the cost of credit and help penetration of the cost of the credit in the ecosystem. So one will need to watch out for these trends, and nothing is going to happen overnight. Any technology to mature takes anywhere between 7 to 12, 13 years, unless until it gets lost on the way. But one will need to keep refining these things as we go along, and slowly we'll reach a place where overall efficiency of the system kicks in, whether it is from a credit underwriting perspective, acquisition perspective, or cost of capital perspective. Yeah. While the other piece, I think contrary to that, one will need to keep in mind the entire fraud risk. As we go along, they will become more sophisticated, etc. And hence the cost involved to prevent those frauds will be higher. So that's one thing which one will need to manage.
Thanks, Ashish. I think very well put up by both our panelists. If the costs need to reduce to the end borrower, whether it is an SME or a consumer, I think two important aspects, because the lending company also needs to lower down its cost, whether it's cost of acquisition or cost of risk, as pointed out by Ashish. And I think one point which I think Rohan mentioned was co-lending, and that can be effectively used actually to lower the cost to the ultimate borrower. Yeah. So I think moving on, it's 2030. So obviously we are talking about a lot of product innovations. And over the last 7 to 8 years, since fintech has been dominant in India, and I think Ashish pointed out that there have been a lot of product innovations, not only in terms of the entire consumer lending process flow or the SME lending process flow, but in terms of how things get done. So, Ashish, coming to you first, and what do you think we will see? What is required in terms of product innovations, and what are some of the product innovations which probably are required today in the entire lending space?
So, see, whatever has happened in the last 5, 7, 10 years is largely on the unsecured side of the business, whether it is BIL or whether it is pure play PL or the consumer loans, as they say. And if you were to look at the market, about 60% of the market is still secured, largely linked to property. And if you were to peel the onion further, what is the difference between a secured loan and an unsecured loan? Virtually, till the sanction stage or you're doing the credit and evaluation of the entity or the consumer, everything else is, remains the same. The difference comes in when you have to talk about legal, technical valuation and hence dispersal. Because those components are not involved in unsecured, it's a breeze. But as we go along, my sense is some of these components of legal, technical valuation will get addressed, and hopefully much before 2030, in 3-4 years, because a lot of land records are getting digitized. And look at how the tech is evolving. If you were to look at a simple piece, my favorite example of a blockchain, and put entire land records on blockchain, it's a trustless environment, fairly secured environment. So the need to go and do the due diligence for 15 years, 20 years from a legal standpoint, etc., can be done in a jiffy. Valuation, starting, there are enough and more websites, Magic Brick and others, who have reached a decent amount and accuracy in terms of the valuation. The circle rates are a published piece. So if there are models which can get developed where the circle rate is published, the property price index is reasonably matured, and it is published, so that, and plus this entire evaluation of the RERA data coupled with what are the rates at which the builder is selling, what flats got sold at what rates, etc. And you arrive at a reasonable valuation of the similar properties in the similar vicinity. The moment you solve for that, then the efficiency gains which have to happen on the secured lending is great. Then the ticket size of secured lending can come down. Rates of secured lending are any which way lower, but you have to grow mass, right? And hence the entire process innovation will help you take it much more mass, and hence even the ticket size will come down, because it's the unit economics will work in favor of smaller ticket size, whether it's micro lab or affordable housing, etc., even in the segments of 5 lakhs, 7 lakhs, 10 lakhs, etc. So those are pieces I think will come in from a pure play tech play, which will get evolved. So that's one big take which I'll have. The other big take which I think will happen is everything will get funded at point of purchase, whether it is in the wholesale scenario or on the retail scenario. There could be multiple ways of funding, whether you could have BNPL, you could have save now, pay later, you can have invest now, pay later, whichever way you decide to call it. But if there is a deficit of the amount required to enable that purchase, a lot of point of purchases will come in. Right. As a result, satiation of credit will happen, and also what we will move to is customer level limit rather than a product level or an asset level limit for a customer. So there will be uniform underwriting of a customer. Each customer has an X amount available. Depending on what product category you take, it keeps debiting that limit. So those are something which I feel will evolve.
Interesting, interesting. Coming to you, Rohan, what are your thoughts on probably some of the product innovations or some of the innovations required in digital lending?
Sure, I think very well said by Ashish on the customer level credit as opposed to just product level credit. For product level credit, I think first and foremost, which most of the players in the industry obviously try to follow, is the customer experience. Right, the experience in our view at least matters much more. It doesn't matter if the cost of lending to the customer is slightly higher, but if the experience is seamless, it matters a lot. So how do you combine traditional underwriting models with some form of alternative data as well? Now there are some lenders that lend to any kind of customer based only on alternative credit models, which may work very well for them. So what we have done, at least from a product standpoint, is try to combine some alternative credit models. For instance, repayment behavior of the borrower in the past, in the last 6 months or last 12 months, for instance, whether it's a mobile bill, whether it's a utility bill, etc. That can help you in product innovation in terms of what exactly does the customer need, because you can see the spend done by the customer. So I think that's one. Number two, I think product level, there's a lot of other innovation that still has to happen. So simplest example that I can think of is a woman-led business product. Woman-led business product, it's very common over here in India, at least for most women, I won't say all, for most woman-led business products, the collateral or the business will be owned in the name of the husband, the father, the son, the brother, etc. Right? How do you provide credit to that entrepreneur then when none of the collateral is in her name? Right? What alternative credit models can you develop? Can you innovate on product that gears an organization predominantly towards a women-led product, for instance? I think certain other things as well, product level will also have to be catered predominantly towards the cohort you want to lend to, towards the customer subsegment. So for instance, at least our customer subsegment is MSME, which will be very different from the millennial or the Gen Z or the Gen X customer in terms of how you'll gear a product towards that. So Gen Z, Gen X, millennials will be, very, very different. What we did for MSME is, instead of taking dukaan or makaan as collateral from the borrower, we said, why don't we build a gold finance business geared towards MSME customers, because that collateral is freely available with the borrower. Number two, it can get pledged with a turnaround time of 20 to 25 minutes. So the experience for the customer is seamless. Number three is, you're not then married in a 2 or 3 year product. The customer can come and redeem it at any point in time. So the experience for the customer became fairly seamless. Obviously, we had to build out the entire infrastructure around gearing our business towards that product. So I think those kind of product innovations will be needed in the future. I think the other part also in terms of product is, for most of us as lenders, how do you retain the customer and engage with the customer throughout the life cycle of the customer, not just life cycle of the product, will be most important. So can you do some form of product innovation where you continue to engage by not just offering credit? Can you offer anything other than credit, right? It's very common to offer life insurance policies, health insurance policies, etc. But that's more of a cross-sell revenue generation for an entity rather than product innovation for the customer. So I think there's a lot of work that can still happen over there, but it will happen once you develop more and more data science, data intelligence around your core cohort. That is most critical. It can't be a one-size-fits-all approach. It has to be very specific towards a customer cohort.
Absolutely. I think any innovation that takes place needs to actually ultimately benefit the customer. Very aptly put in, Rohan. I think I'll start the next one from you. So as we innovate and as we move ahead in digital, what are the expectations that we have from governments? What are the expectations that we have from regulators?
So, actually, fun fact is, interestingly, someone pointed it out at work to me the other day. In 2008, when the iPhone was launched, only 17% of Indians had a bank account. Then it was envisioned that by the time what today is almost 80% of people in India have a bank account, it was envisioned it will take 46 years to get there. So this will happen sometime in 2054. Interestingly, we're already there right now. So I think the government has done a lot obviously this is a mammoth effort, right? It has to flow right from the top to the bottom. But I think certain other things to facilitate also, for instance, what they're doing very recently, I believe, is a pilot of a program where small business owners will be given a URC certificate immediately. Now, this until recently had to be something they had to apply for. They could go in online into a portal, get it in 20-25 minutes, but it still is something that is not automatically given to a small business owner at least. So I think the government's done something recently. I believe they're piloting in one city right now, and then they'll be taking it across based on the success of the pilot. I think certain other things is, for instance, the guarantee program, CGT SME. Can you make the CGT SME applicable not towards only micro, small, medium enterprise businesses, but also medium enterprise businesses? So I think, that also, given the guarantee from the government, some really small businesses kind of get worried to invest in infrastructure, upgrades, etc., because they don't want to lose that guarantee. So can this be applicable to medium-sized guarantees? Can MSMEs apply for the CGT SME guarantee, and can they get that, and based on that certification, can they go to a lender and ask for a lower rate of lending, right? Can that be a seamless process? I think that could be another one. And the third one is, at least from a small medium enterprise borrower standpoint, is can you have a one-stop shop, or can you have one platform where they can access all the benefits, be it subsidies, grants, etc., etc. Can they access this all in one place, right? So, I mean, I think a lot can get done, and this is just for small, medium enterprise borrowers. I think even for consumers, like, can you access all your life insurance policies, for instance, right? All in one place. Can you actually see what kind of health insurance do you have? Be it by your employer, be it the individual health insurance that you have purchased through a health insurance company. Most consumers, at least my view is, don't even know what they really have. It's like saying, when you get a car insurance also, do you really know what exactly is covered as part of your car insurance? So those kind of things, I think, if they can get simplified, I don't think the onus of that should just be on the government or the regulator. I think the government and the regulator will have to really get a lot of the corporate sector involved in this, because it is a mammoth effort, and it will take a lot of data science to actually get this up and moving.
Got it. Ashish, your thoughts on that?
I think great points, Rohan. Just a couple of pieces, like Rohan mentioned that lot which is happening, but any of these large initiatives which have to be impacted at a scale obviously take time to build scale and then get the results at scale. Some of the pieces, I think, given the fact that we have 7 crore MSMEs, etc., 6.5 crores, whatever that number may be, and that will go to 12-15 crores in next 5 to 7 years, as well as the penetration of credit will increase. So it's a huge opportunity which is there. So one of the problems plaguing that at this point in time is a seamlessness of KYC. Seamlessness KYC through eKYC or video KYC, etc., exists for an individuals, but that is still not as much smooth when it comes to proprietorship, partnership, private limited concern, so on and so forth. So that's one area, if get solved for, will be a big piece from a growth perspective. The second piece is obviously initiatives like Open ONDC will take shape. They will provide a lot of data, build layers, and it will take off. The third piece, I think today, if you were to look at last 15-20 years since the time NBFC have been in play, whenever there is a downturn in the cycle, NBFCs are the worst hit, because banks just stop the tap for lending, and inherently NBFCs end up carrying higher risk customers who are more impacted when the cycle takes a downturn, because they are more on the fringe, and at the same time the tap gets turned off. So in case there can, now that we have tiering of NBFCs between category 1, 2, 3, 4, can there be more facilitation so that overall in the ecosystem across business cycles, we have different category of lenders catering to different category of segments, and as the consumer moves up the credit path, they can keep shifting from category A to B to C to D, and as the result keep getting the benefit. Some part of it, I think, is the intent, as Rohan mentioned, in terms of co-lending, but there's a lot more which can be done there, so that there are preferred lenders and the customer knows that this is where I would go in and get the best deal given my credit profile at this point in time. So I think a lot of work on that side as we move along will help.
Sure, sure. I think obviously the regulator and government has been very, very proactive. And I think Rohan mentioned, right, what they've been doing from about 17% to about 80% of bank accounts already open. Any thoughts, again, to both of you, in terms of any, today we have, say an Aadhaar or a PAN or Udyam ID and GSTIN. Can we all make it one for the ease of access and, one data so that easily accessible and can use it for anything? Any thoughts on that? Ashish, to start with.
Yeah, I think that's a great point, and I'm happy that in the budget at least they mentioned that PAN will be the key driver for the entities, etc. Because if you were to really look at entities, you have PAN, you have GSTN, then you have Udyam Aadhaar, then you have LEI, and there's no place where all entities in the ecosystem has any one of these. B, no place where even if these exist, they are linked. As a result, the unique identity of an entity still continues to be a challenge for all practical reasons. So if Aadhaar, if PAN is the one, then it can be PAN. Obviously, LEI will need to come in because of the international presence, etc. But then it just like how Aadhaar and PAN are getting linked for individuals, even for entities, LEI and PAN should get linked. And then you should be able to do everything from GSTN basis PAN. I understand GSTN basis state-wise, etc. If you have multi-state operations, you will need to have separate numbers, but inherently they can be linked to a PAN, which could be a group GSTN kind of a thing. So that will just simplify this entire process of identification, authorization of the entities and their owners.
Sure, sure.
Yeah.
I totally agree with Ashish. So, as the single point of verification, for instance, if you just go back and look at what happened in the US from, say, 2010 onwards, at least 2 or 3 years post the crisis, because usually after a crisis in most economies, you then have a new wave of, we call it tech companies, fintech companies, digital lenders, etc., that come and totally change the landscape. So if you look at what happened over there as well, it was made easier because of the single point of verification, which essentially is your social security number. So with your social security number, lender could access whatever they wanted. Obviously, they'd pull your credit score through the bureau, they'd look at your repayment track record, which the social security would not give. But in terms of customer identification, that was one point of contact, which made it much easier. And then you had certain innovation along the way in terms of product. So I think something like that, I totally agree with Ashish. It could be a game changer. Obviously, what we'll have to do as an economy and as a nation is, given the volume of people, it's not going to be something that happens overnight. It is something that, as you collect more data, as a lot of other things have to fall into place, it will take time. But we have the demographic dividend to our side where it will happen, and if it happens successfully, I think it'll be a complete game changer.
Yeah, I'm sure. I think we can do it because Aadhaar, in fact, is a case study in itself in terms of how the entire UID thing has happened. So I think everybody speaks about India Stack, Jan Dhan, Aadhaar. Additions to India Stack, do you think coming up in 2030, maybe from AA to an OK and to an ONDC? What are your thoughts on that?
Yeah, I think definitely Oaken and AA built on Oaken, and then ONDC will stabilize by then and give a lot of results. Then, like I mentioned earlier, over extension of AA for anybody to contribute data and anybody to access data, as long as with the consumer consent with the appropriate framework should help. And the other piece would be also building block in terms of either your open AI or blockchain, etc., so that it becomes easier for smaller entities to access that technology and leverage that technology. So that the platform the public utility platform will provide the base platform layer. Then there will be fintechs who will come and develop specific applications on top of that, which then they will peddle it out in terms of software as a service or a platform as a service, so that it becomes unit economy wise easier for people at mass to consume that layer.
Understood. Rohan, yours?
Don't think I could add much to what Ashish said. I totally agree over there.
Sure, sure. But again, a follow-up question on this. It does take time, right? I mean, obviously, it cannot be built overnight. I think we saw A taking some time before getting fraction, getting that transaction traction and all that. What is your view in terms of that? I think, can we just have a plug-and-play model, or we need acceptance across, we need to push things across? How does this actually pan out?
See, whether you ultimately, when we are dealing with human beings, whether it is processes, products, or anything, everything will take time. You'll always have innovators, you'll have early adopters, there'll be people who will wait and watch. And that's why anything and everything, when it has to be built at scale, you have to solve for complexity, because without solving for complexity, you'll not be able to solve for scale. And if you wait for solving all the complexity, you'll never ever go live. So go live, keep solving for 10, 20, 30% of your population. As that scales, you'll get to know and learn more nuances, keep solving for that, and it's an iterative process which it'll take. And there's a simple thing, look at anything, you know, as simple as we talk very highly of UPI, and it is indeed a great product, but today when we look at it, it's a 6-year, 7-year product after launch. 2016 is when it got launched, and mind you, there were 2 black swan events which pushed it. Demon in the first year itself, and then COVID, right? It's come really of age there, and still there's more which can be done, but it's an ever evolving piece. So you pick up a large enough canvas, you start by painting small, but keep building it as you go along.
So, may not be pertinent exactly to this question, but to your earlier question earlier as well, just on product innovation. So, if you look at, for instance, what's happened in the wealth management industry in India, I think there's been significant enablement through digital means, right? And one of the reasons that one could attribute as to why it happened in wealth management, probably because the volume is much smaller. So the quantum of people that are being catered towards in wealth management, while obviously it's a large number, but relative to what needs to get developed and catered towards in mass scale, it's much easier to do in wealth management. But I think if, you know, there are additions in the India stack to make it much easier for the Aam Aadmi, right, in just simplicity, in being able to themselves, they could live their life easier, they could access what they are doing, they can see where the, you know, for instance, money is spent, etc., many other things. There's some kind of platform that way. I think that will be really helpful, and not just will it help lenders. I mean, it'll help lenders, it'll help in the lending machinery, etc., but most important is it has to help the Aam Aadmi.
Absolutely, absolutely. Rohan, your thoughts on white spaces for entrepreneurs?
I think the biggest white space, which again goes back to your first question on bringing down the cost of capital, is around the co-lending model and around having a tech platform or a digital platform, which is a plug and play, and obviously you'll have to gear modules based on different lenders, etc. I think that's a very big white space because again over there it will still be hard for a plug and play. So you will have to not just develop it for regional nuances, you also have to develop it for, you know, product nuances, lender nuances, etc. So even a simple unsecured business loan product, for instance, ticket sizes, credit policies, collection methodology, etc. I think that's a very big white space that will evolve. I know there are people who are trying to gear platforms towards it, but you can't just have 2 large platforms towards it. I think you'll probably need 20 large or semi-large platforms that build on this, obviously based on the fact that our expectation is that this will continue to get bigger. So, you know, our view, at least as an NBFC, is that co-lending is here to stay. I think that's a big white space. I think one space that a lot of people have gone after already is this whole neo-banking platform. The issue over there with neobanks is, while it definitely is a brilliant service, who owns the end customer. So some amount of clarity over there. But at least the big white space that we see is a tech or digital platform geared predominantly towards co-lending, and that can be extremely large because you have business loans, car loans, loan against property, gold loans, etc. So commercial vehicles, it can be extremely large. I think that's still in its very early stage, in a very nascent stage.
Sure, sure. Completely agree. Your thoughts, Ashish?
Just one large space I think which exists and may not be purely from a lending perspective, but that enables itself for lending is this: if you were to look at neobanks, largely people are going with the liability side of the business, which is catering to the millennials. By inherent customer demog, the size of wallet of the millennials, etc., will be lower, and by the time they reach 35 or so, then the size from a savings and the liabilities perspective starts becoming decent, and it keeps growing because of the surplus funds, and that might be typical of a salaried segment. And hence, to my mind, there is a important place where people who may not be native to net, which is 35 to 45 years of space, nobody seems to be looking at that segment, which is fairly comfortable with the technology, has a decent ticket size, and they will have play in spending, lending, as well as investments. So that segment is, I think, a big enough segment to be catered to. That's on one side. The second piece is still the entire financial literacy component, particularly for the women in India, is something which is great. I know there are some entities which have started working on that, but that itself is a very, very large segment as well, which exists.
Interesting. Well said, I think. So I think last 45 minutes we have been speaking about newer products, innovations, part to lower interest rate to the customers, expectations from regulators and government, and ultimately, what is the white space open for entrepreneurs as well. So I think amazing discussion. Thanks, Rohan and Ashish. I think opening up to the audience as well in case anybody has any questions. So yeah, please. Can somebody give a mic there? You can introduce yourself and ask a question. Thanks.
Yeah, hi. My name is Dikshant. I'm kind of exploring lending as a space for my next venture. My question to kind of, all the panelists here. So looking at 2030, which is 5-7 years down the line from here now, what do you think about lending? Like, will it evolve towards more vertical specific lending? Or will it kind of, will we see more generalist players? The question is, will we see more NBFCs specialized towards certain verticals, basically having knowledge about that vertical and hence be able to better underwrite, but the portfolio size is smaller, or more generalist approach, kind of larger book sizes and hence cost of capital lower? Which one, according to you, kind of, we see towards 2030? Like, what will we see? Just your views. Thanks.
Rohan, you want to go ahead?
Sure. So our personal view is it'll be the former. It'll be more product specialization, smaller books, focusing more on profitability. I think that's also born out of the fact just what Ashish had mentioned earlier, right? In terms of layering and tiering the NBFCs and how the cost of capital and how access to capital for them will be made easier. So if you just look through what we in India have been through, especially post IL&FS, it's become very apparent that, in good times it's very easy to access capital. But these black swan events happen more often than we actually think they do happen. So at least our view is by 2030, it'll be more of a specialist game in terms of product verticals that NBFCs cater towards. Many of them are big, many of them will become bigger, but there's also a risk of becoming bigger. So are you too big to fail? We've seen that too big to fail entities have also failed. So it's not going to be that easy. I think many, at least us and many others may take a call as well that as you get bigger and bigger, you carry those many more liabilities on your balance sheet as well, right? That is the big risk because that has more gyrations or as many gyrations as you do have on the asset side as well. So at least our view is it'll be the former, more product specialization, more vertical specific NBFCs that specialize, and some of them may be more state specific as well in certain geographies that they cater towards, because there are regional nuances to lending.
Ashish, you.
Just to add to that, I think if you were to look at it, this will not be either or, right? If you are a generalist, then you will have to do it with scale because you are handling multiple consumer segments. And if you are becoming a specialist, then you own a consumer, whether it is geography, whether it is industry, and then if you want to play in multiple categories, etc., then you own the customer and do it. So you will have to, from a startup perspective, you will have to solve the detailed issues of the customer. The easy things to be plugged would have gone, and hence the value will derive when you get into the details. And then as you keep getting into the details of either multiple segments or multiple products, you will become a generalist. But for generalists, you need to have scale, right? So if you at a low level of scale, if you want to mean everything to everyone, that may not be the recipe for survival and growth.
Just to add one point there, the capital is also very critical. So for the capital that you have, and as a startup or a new NBFC or a smaller NBFC, where do you put that capital to get the maximum benefits? So then, you choose between the segments that you want to choose. And hence, to what Rohan and Ashish said, you need to pick up a segment which you can service well, have the right tech stack, and give the maximum benefit to the consumer. So you probably will go there. Thanks. Yeah, you have one question for me?
Yeah, my name is Sanket. I'm building some solar platform in clean fintech area. So my question to you is, how do you guys see co-lending becoming, cutting across sectors and cutting across customer segments? Because you mentioned that co-lending will become big. So, a little bit more elaboration on how it will grow.
Sure, Rohan.
Yeah, so it'll have to be banks that understand the product, that are able to co-lend with an NBFC who understands that product extremely well. Because usually in these relationships, the larger lender is a capital contributor, whereas the smaller lender, who contributes between 10 and 20%, that is the entire front face for the customer or the corporate entity. So the entire sourcing, servicing, collection is left to the smaller player, while the capital is contributed by the larger lender. So it'll have to be, again, product specific, NBFC specifics, an NBFC that really understands the sector, and the bank has to be very comfortable with the product. So far, most of the co-lending products have been on the cookie cutter conventional products that have always existed. So business loans, secured or unsecured, loan against property, affordable home finance, etc. For something like solar, it'll require a lot of specialization.
Okay. Will it bring down the cost of capital because the larger banks are a part of this whole co-lending arrangement?
It should, but it'll also depend on the product. So for instance, if you're doing co-lending on an unsecured business loan product, the IRR or the hurdle rate that the bank will want will be higher than what it would be on a home loan, for instance, if they're co-lending. So again, that'll be more product specific, and that's how they'll price it.
Got it. Thank you.
Just to add to that, when you're talking about solar panels or anything else like that, you have to look at how the maturity model will go in. So when you are wanting to set up a new industry, example green energy, etc., there are so many unknowns at this point in time. And hence, the first step will be access to lending. Then when there is a critical mass which comes in, there's a critical period which has flown through where the loans have performed or otherwise, then you look at how do we bring in efficiencies, including the cost of funds and hence the cost of lending.
Thanks Ashish and Rohan. Thank you all. I think we have overshot the time, so we can take some of the questions if you have offline. Thank you all. Thank you.